Let's say you invest in the Amazon company and you think that Amazon is going to rule the world, but then something happens and now the Amazon company goes bust. Well, now so does your investment. What's up everybody, I am Jaspreet Singh and what I want to do today is talk about how to stack your cash, where now you're taking a little bit of money and you're investing it again and again and again. But what I want you to do is now take this money that you're investing to grow. That way now you're investing more money, but the money that you're investing is also growing. That way now you have a growing portfolio that's growing because you're putting money into it, but then the more money you put in, the faster this money grows. That way you create the self-perpetuating wheel where you put more money and the money grows more. You put more money, the money grows even more. That way you can build this compound effect where you're building the snowball that's growing faster and faster and faster. So let's jump right into it. The whole idea behind compound interest is you're going to invest some money today. This money is going to grow, and now you have your money working hard to make you money, and the money that your money made working hard to make you money. So it's almost like your money is having babies, and your money is just going to keep compounding and growing, which means you have more money working hard to make you money. Even if you're not investing your money in the traditional sense, you should hopefully still be earning this type of compound interest, because if you go to work every single day, you're compounding your knowledge and your skills. And so the longer you go to work, the more skills you're going to learn, and the more valuable you're going to be as an employee. That's why as you get older, your pay should hopefully go up too, because you're compounding your knowledge, you're compounding your skills, and now you're more valuable, which means you should be getting paid more money. It's the same concept with your money, except more money doesn't give you more skills, it just gives you more power. Like this $100 bill doesn't have more skills than this $20 bill does, it just has more power, because assuming that $1 will buy me a machine that's gonna make me a nickel, now with this $100 bill, I can buy 100 of those machines. With this $20 bill, I can only buy 20 of those machines. So I'm gonna be able to earn more nickels with this $100 bill than this, just because I got more power with this piece of paper than this one. But this is where compounding becomes so powerful, because every dollar I earn will buy me another machine that makes me a nickel, and I need 20 nickels to earn $1. This $20 bill will get me 20 nickels, which will buy me one more nickel making machine. This $100 bill will earn me 100 nickels, which will buy me 5 more nickel making machines. So I'll be able to earn more nickels with this just because I got more buying power. The more dollars you have, the more dollars your money is going to be able to make, and the longer you let your money sit there and invest and compound, the more your money is going to be able to grow. That's why Albert Einstein calls compound interest the 8th wonder of the world, because now your money is working hard to earn you more money, and every time your money does that, you're going to have more money that you can send out to work hard and earn you more money. So it becomes a system, almost like this machine that's just working to produce you more money, and anytime you produce more money, you can buy another machine that's going to be working to produce you more money. You don't need a ton of money to start, but the longer you have, the more your money is going to be able to grow, which is why you're going to see the biggest returns towards the end of your compounding. Like even if you start with just 1 penny and you can double your money every single day. Day 1, you have just a penny. In day 8, you have $1. By day 21, you have $10,000. Now your money is really starting to grow. And by day 30, you're going to have over $5 million, and you started with just a penny. Now, I already know what you're thinking. But Jaspreet, if it was so easy for me to double a penny, I'd already be doing that right now. Now, I know it's not easy to double your money every single day, and that's not the goal, but you can do this over time. There's a couple different strategies that you can follow to compound your money and really build your wealth over time. There's an active strategy and a passive way. Actively compounding your money is literally what the word says it is. You are being active and you are buying something, selling it, and now you're using your profits to go buy something else. You see this all the time in real estate. You go out and you buy a $100,000 property, you renovate it, whatever, you fix it up, and you go sell this property for $150,000. Now instead of going and buying another $100,000 property, you go out and you buy a $150,000 property and you renovate it, and now you sell it for $225,000. And so slowly you are growing your money and compounding your money because you can do bigger deals. Now you can do 2 deals at one time. You can do $200,000 deals and hopefully sell both of these for $150,000 each. And now you're just compounding what you're doing. You're slowly growing what you can do because you make some money and you take your profits and you reinvest it into whatever it is you're doing. This is exactly what I do on YouTube. Anytime somebody watches our videos on YouTube, I get paid. Thank you for your penny. Now, when I get this YouTube money, I can take all of it and go out and buy myself some new exotic cars, go get myself a new Gucci wardrobe, and go enjoy some fine dining at Chipotle with some extra guac. But what I actually do with this money is I reinvest this money back into our business. That way we can grow our business bigger. I'm reinvesting it back into our blog, I'm reinvesting it back into our newsletter, and I'm reinvesting it into an app that we're making. I'm actively working to compound this money by sacrificing some of these luxuries today that I could buy by reinvesting this money back into the business. That way I can grow the whole pie bigger. When I was in college, I started a cell phone accessory business with a friend of mine, and we didn't have a ton of money, and we wanted to start selling these like cell phone battery packs. And at the time we only bought like 10 of them because that's all we could afford. And so we bought 10 of these battery packs and we sold them, and then we took this money that we got and our profits and we went out and I think we bought 20 battery packs, and then we bought 50, and then we bought 100. And so it was like a slow compound where we took whatever money we had to buy these battery packs, we sold them, then we took this money and our profits and we compounded it. And that way we were able to buy more, sell more, buy more, sell more. And so you don't get to enjoy the profits when you're compounding it like this, because if you're taking all of your profits and reinvesting it, you're actively compounding it to grow the whole thing bigger. When you do this, the hope and the whole idea is you're gonna start off with something small, $100 or $1,000, and you're gonna grow it to something a little bit bigger. You're gonna turn $1,000 into $2,000. Now you're gonna reinvest the $2,000, turn it into $4,000, then the 4 to 8, the 8 to 16, and you're gonna slowly keep growing it. There is a risk though, because if you keep growing it and you don't take out any money for yourself, eventually there's a chance that things don't work out. And now you grew your $1,000 into $100,000 or $1 million, and then things fail. And if you didn't take out any money for yourself, now you're left with nothing. So if you're doing this type of active compounding, you really just gotta find the right risk balance for you, because anytime you pull a dollar out, that's a dollar that you cannot compound. But if you keep the dollars in there, then you take on more risk. I mean, this is one of the things that made Elon Musk so financially successful, because in the early stages of his career, when he would make $25 million, he would reinvest all of this money back into his business, and he would leave nothing for himself, because he wanted to compound and grow his dreams and his wealth by taking every dollar he had and throwing it back into his beliefs. The second way you can compound your money is the passive way, and this is what a lot of people think about when they think of compound investing, because now what you're doing is you were taking your money and you're putting it into an investment, and you're gonna let your money grow, and anytime your money makes money, you are gonna reinvest that money back into it. That way this money that you have growing is gonna keep growing, even if you don't add money into the pot, because your money is growing and this new money is gonna be working to make you money too. When I was in high school, anytime we talked about compounding or investing your money in my math class, the example that my teacher always gave me was investing your money in a CD in the bank or a savings account. So the way it works is you put your money in the bank, either in a CD or a bank account, and then your money is going to grow, and as your money sits there, it will compound and grow, because now this money that your money made will grow even more. But the interesting thing about this, so if we write bank account, you're not going to get a very good return, especially nowadays. A savings account nowadays is going to pay you like 0.1% if you're lucky, and a CD is going to pay you 1% if you're lucky. So if we look at this where you get a 1% return on your money, and I'm being very generous here, it is going to take you a long time for you to double your money. At this rate, keeping your money in the bank is going to take you 72 years to double your money. So you're not building wealth in this lifetime. Maybe your great grandkids will have some decent money to play with. If you're really looking to compound your money and grow your money, then you need to be putting your money in assets. So this would be things like the stock market. If you're investing in your money in the stock market, the goal is to grow your money by investing in companies that you believe in, because over time these companies are going to make more money, which would make the stock price more valuable for you. Now, if I come back here to active, if you do a business or flipping like we talked about, there's really no limit or kind of a baseline to how fast you can grow your money here. I mean, it's not super unreasonable to see 100% growth in a year, so it's really kind of uncertain as to how good of returns you'll see. It just depends on what it is you're doing and how good you are at it. So, there's really no baseline here. The stock market, on the other hand, has gone up by between 8 to 10% a year historically. So even if we stay on the low end here, 8%, you're going to be able to grow your money much faster. And the thing you got to understand about the stock market is there's a couple of different ways that you can make money. You can make money through appreciation, which is when the price of your stock goes up, and you can also make money through dividends, which is when the company that you invest in literally just gives you a cash check. So if you can grow your money by 8% a year in the stock market, you can double your money every 9 years. That's a whole lot better than 72. Now, if we kind of really look at compounding your money, this is where a lot of people assume that you have to invest in dividend-paying companies, which are companies that pay you cash payments. That way you can compound your money, because in that case, when you get this dividend, then you could reinvest this dividend back into the stock market and buy more shares. That way now your money is actually growing. So you invest in a dividend-paying company, this company gives you some cash, then your money automatically gets invested. That way you can own more shares, and now as you own more shares, you're going to get more dividends. As you get more dividends, you can buy more shares. So it creates this reoccurring cycle of growth and compounding. But what I also want you to understand is that not every company pays a dividend. The only companies that really pay dividends are really your more established and more mature companies, because these are companies that at the end of the year, they have so much cash in their bank account, they have no better use for their money. Because if they could reinvest this money back into their company and grow their company bigger, then they would probably do that. But they have so much cash where they're just like, you know what, let's just start giving it away to our shareholders because we have no better use for this cash. And so people assume that the only way to compound their money is to invest in dividend-paying companies, because these are companies that are giving you cash, and when you get this cash, you can reinvest it. But you can also compound your money by investing in companies on the stock market that are reinvesting their profits. If you find more of a startup company that you really like and you really believe in and you think is a good value, and you invest in this company, and this company, anytime they make money, they don't give it away in dividends. They take this extra cash and they reinvest it back into their company, so they're really not making that big of profits. Like how Amazon during the early years of it being public never made any money, because anytime it made money, it reinvested it back into the company. If you invest in a company like this, then your money is still compounding, because you own shares of a company that's using all of its money to grow itself. And so while you're not getting this cash payment and accumulating more shares, your shares become more valuable because of this compounding, because the company that you're investing in is compounding all their money because they're taking all of their profits and reinvesting it. And there are pros and cons to both, because this type of investing, where you invest in more of a startup type company, has more risk, because there's a chance that this company will fail, like we talked about here. If you're actively compounding your money, which is what this company is doing, there's a chance that it could fail. And so yeah, they're reinvesting all their profits and they're doing everything they can. But if this strategy fails, then there goes your investment. But on the flip side, with these dividend investments, because these dividend-paying companies are typically larger and more mature, you're going to have a safer investment, which usually comes with a smaller return. So you might not see the stock price go up as fast, and your average dividend is typically somewhere in the 2 to 4% range. It really depends on the company, so it's not anything huge, and hopefully it will go up over time, but you just got to kind of understand where you want to be. It comes with lower returns here, higher potential returns here, but more risk. The second thing is with dividends, anytime you get paid a dividend, you have to pay taxes on this dividend. So while you take this dividend and you reinvest it, you still have to pay taxes on the money that you made, even though you don't actually get that money in your bank account, because you're, in this case, reinvesting that money. Another way that you can compound your money is by investing your money in real estate. This is my actually favorite place to invest my money, because not only do you get passive income, if you do it right, you will also get depreciation in the property. And so with real estate, when I invest my money, I'm looking for a 7% annual return on my money, cash on cash minimum. Ideally something closer to 8%, but 7% is my real minimum. Now the thing that you got to understand here is that if I get a 7% return on my money, it's going to take me 10 years to double my money. But in this case, the 7% is a cash on cash return that I'm getting every single year in my pocket. So if I buy a $100,000 property, that means every year I'm making at least $7,000 in profit. Hopefully over time this is going to go up if rent prices go up, but that means I'm making $7,000 a year. And now what I can do is, after 10 years, I will have this cash in the bank that I can use to go out and buy another property, or I can just take my own cash, go out and buy another property, and supplement it with this money that I'm making from real estate. The reason that real estate becomes so attractive now on top of this is because not only are you getting this cash flow, but if you're buying your properties in a good area where people want to live, then you're also going to see the property value go up too. So I buy this $100,000 property, and every year I'm getting $7,000 a year in passive income, but over time, this property might go up in value to, let's say, $200,000. And now if it comes time for me to sell this property, sell it for $200,000, I can do something called a 1031 exchange. It's a little loophole in the real estate world where now I can take all $200,000, pay $0 in taxes, and go out and buy a $200,000 property that's going to pay me with more passive income. And so when I try to do that in the stock market with dividends, the first thing I had to do was pay taxes on my dividends, and then I could reinvest these dividends. With real estate, if the property value goes up, now I can sell the property, pay no taxes today on those profits, and go out and buy myself a bigger property that's going to pay me with more money. Plus, even on the passive passive income, the cash flow that I'm making from real estate, this money that I'm getting here, there's a lot of tax breaks that I get with real estate that I don't get with the stock market. So even as I get the $7,000 a year in passive income, I don't have to pay taxes on all $7,000 because there's other tax deductions that I can take, like something called the Depreciation Tax Deduction, which says that I get to get a deduction because my property is 1 year older. So happy birthday to your property, you get a tax break. So from a tax perspective, you get more benefits here from real estate, but real estate does come with its own downfalls because now you have to deal with more people. Like when you're investing in stocks, you're not dealing with anybody. You can go out and buy shares of Amazon or Lululemon or Chipotle and McDonald's and not have to deal with a single person. You can do this right off your phone. You want to go out and buy a real estate property, you got to have a real estate agent, you got to have a property manager, you got to deal with a contractor, you got to deal with an attorney, and you got to deal with tenants. And so if you don't want to be in that game, the stock market is better for you. Plus with real estate, you're in charge. You're the one that actually has to make sure that your property is generating income, and it's more work on your end because now you got to be the one that's negotiating the deal. And if your tenant doesn't pay or if your tenant damages the property, that's a cost that you have to pay. And of course, the most obvious thing is that it takes a lot more cash to start investing in real estate than it does to start investing in the stock market. I mean, you can start investing in stocks with as little as $100, but if you want to go out and buy a property, you can't do that for $100, at least not a good property. Now, while it's your decision on where you want to invest your money here, here, or here, the idea stays the same, that you need to compound your money. The whole idea behind that is anytime you make money, you want to reinvest at least some of it. That way your money is growing and the money your money made is growing. That way you can grow your money quicker and quicker and quicker over time, because the real secret to building wealth is investing. Yes, we talk about that all the time, but if you really want to grow your money quicker, you got to compound your money, which means you got to have more money in the fire that's burning to make you more money. But I guess if you're burning money, that's probably not what you want to be doing. So bad example, but you got to have more money working to make you more money. I have two different strategies when it comes to investing my own money in the market. I have a passive strategy and an active strategy. My active strategy is where I'm looking for companies, individual stocks, and when these companies go down in price, that's when I come in and buy. So it's more active because I'm actively watching the price of these stocks. I want to see a good price for me to come in and buy, and I'm actively researching each one of these companies. I'm listening to their earnings calls, I'm paying attention to their cash flows. So I'm paying attention to what these companies are doing, and when I see a good price, that's when I come in and buy. My passive strategy is when I buy ETFs. So an ETF is an exchange traded fund, and every week I have a strategy where money leaves my account and automatically gets invested into these ETFs that I've already pre-selected. It doesn't matter if the market is up or down. My passive strategy happens every single week, and this happens passively and automatically, where money automatically leaves my account and it gets invested into these ETFs. You can think of investing in an ETF like investing in a group of stocks, because if you go out and let's say you invest in the Amazon company, AMZN, and you think that Amazon is going to rule the world, you buy the stock, but then something happens. Their executives run the company into the ground, and now the Amazon company goes bust. Well, now so does your investment, because now you invested your money into this company and you're hoping to see a lot of upside because you did your research, you're hoping that this company would grow, but you were wrong. If this were to happen, now you lose your investment. Versus if you invest in an ETF, now you invest in a group of stocks. So this ETF might have companies like Amazon. Now, I'm not saying this is what's going to happen to Amazon, just an example, but this ETF might have Amazon and McDonald's and Coca-Cola and a whole bunch of other companies. Now, if Amazon were to go bust, you're okay, because your ETF doesn't just have Amazon. It has Amazon and hundreds of other companies in there, and you're getting exposure to all these companies. So if one company were to go bust, if one company were to go bankrupt, you're okay because you have other companies to balance it out. The advantage with this is obviously you have less risk, because now you're not just investing in one company, you're investing in a whole bunch of different companies, and it requires less work on your end because now you don't have to individually research every single one of these companies. You find the right ETF, you buy it, and then you just keep letting the ETF do its thing. The downfall with ETFs is you also limit some of your upside, because now instead of just investing in one company, you're investing in a whole bunch of companies, and if now the opposite happens, you invested in Amazon and they did take over the world, they started ruling the world, well, now your investment here will be worth way more. And in this case, you'd have Amazon in your ETF, but it'd be balanced out by some of the losers. So with ETFs, you get more kind of a normalized return, because you have some winners and you have some losers, which are balanced out. But in this case, you also have the risk of your company going bust, and you have to put in all the research. So for most people who don't want to put in all the work or who don't want to take on the extra risk and who don't want to keep up with companies, they just want to invest their money in the market and let the market do its thing without investing all that time. Well, ETFs are a better and easier strategy for you, and that's why I want to go over 3 different types of ETFs with specific ETFs that you want to consider investing your money in. That way you can grow and compound your wealth. So the first kind of ETF that you want to consider investing your money in is an ETF that gives you exposure to the S&P 500. A couple examples of this would be VOO and SPY. Now, a couple disclaimers before I get into this. You are never guaranteed to make money when you invest. You might even lose money. So you should always do your own due diligence and never blindly listen to a random guy on YouTube. I'm going to be talking about a bunch of different ETFs in this video. Some of them I have invested my money in myself, and I will give you those disclosures, like I've invested my own money in VOO. But the reason why I say you need to always do your own due diligence is because what's right for me isn't always going to be right for you. So just make sure you do your own research. The S&P 500 is an index, meaning group of stocks, which are the biggest 500 companies on the stock market. So if you go to the stock market and you pick out the 500 biggest companies by market cap, meaning the valuation of these companies, this gives you the S&P 500. Now, instead of you going out and individually investing in all 500 of these companies, you can invest in something like VOO or SPY. These are the ticker symbols for the ETFs. If you invest in either one of these, you are now indirectly investing in all 500 of these companies, because VOO and SPY both invest in the S&P 500. They give you exposure to the S&P 500, the biggest 500 companies on the stock market. Now, when it comes time for you to actually invest your money into an ETF, there are 3 big questions you always want to ask. The first question is, who made the ETF? Second is, what do these ETFs actually invest in and what percentage of each company? And third is fees, because you don't want to give all your money to fees. And so you got to understand these 3 questions to help you understand where you should actually put your money. So let's start talking here. Who made this ETF? VOO is an ETF made by Vanguard, and SPY is an ETF made by Spider, SPDR, they're pronounced Spider. But these are 2 different companies, both investment companies that create ETFs, which allow you to now buy ETFs. Both Vanguard and Spider are both very reputable companies, and so when it comes time for you to actually research ETFs, you want to look at how credible is the company that created the ETF, because you're going to have a whole bunch of newer, no-name companies releasing ETFs and index funds all the time, but if they have no credibility, they have no history, you don't want to just dump your money into them, because what if they go bust? So you want to look at who made this ETF, Vanguard and the Spider, and also along with that, how many people are actually investing their money into these ETFs? How big are these ETFs? The easiest way to find that information is just to go onto the Vanguard website or the Spider website and actually look at these ETFs. They'll have a fact sheet that will give you a bunch of information, everything you need to know about the ETF itself. So if you go onto the Vanguard website, here I'm on the VOO page, and you see it says the fund total net assets, which is $829 billion for VOO. And then if I come onto the Spider website under index statistics, it says the weighted average market cap, which is currently 668 million, which is $668 billion. If you search online, the general rule of thumb is if you're investing in an ETF, you want to look for an ETF that has at least $10 million in market cap of actually assets that are being managed in order for it to be an actual worthwhile investment to protect your money. But I like to look at something a little bit safer, especially if it's an ETF, because I want my money to be safe. So I'm looking at least $100 million on the low end of assets under management. And both of these in the hundreds of billions are way past that. So we know that 1, they're made by a company that's credible, and 2nd, that they have enough assets under management for it to be an okay investment. The second question you want to ask yourself is, what companies do these 2 ETFs invest in? So we know that both of these ETFs give you exposure to the S&P 500, meaning they both invest in the same 500 companies, but they don't invest in the same 500 companies with the same ratios. Let me show you what I mean. So I'm going back onto the Vanguard website, and right now I can see that the 10 largest holdings are number 1, Microsoft, number 2, Apple, number 3, Alphabet, which is Google, 4, Amazon, Tesla, and on and on and on. But if I go to SPY, I'm going to see here at the top holdings, number 1 is Apple. Number 2 is Microsoft. Number 3 is Amazon. Number 4 is Tesla. Number 5 is Alphabet. So you can see it's very similar companies, but what you see is that the percentages are different, because in SPY Apple is the number one holding versus in Vanguard, Microsoft is the number one holding. This question is going to have a lot bigger implications in the other ETFs that I talk about, because those other ETFs are going to be investing in different companies and different types of companies. But in this case, both of these ETFs are investing in the same companies, just in a different ratio and a different percentage of each one. So you can take a look at them, see what their top holdings are, and see which ones you like better. Now, in general, you don't need to spend a ton of time trying to get into the nitty-gritty of each individual company in these ETFs, because the whole point of investing your money into an ETF is for it to be passive. And so you just want to get a kind of general idea of which companies that they're investing in, and if you like the companies, then the ETF might be a good investment for you. And the third question you want to ask before you invest your money into any ETF or index fund or mutual fund or really any investment is, what are the fees? So in general, ETFs have much lower fees than something like a mutual fund, because these ETFs are passively managed. So a mutual fund, which is something that a lot of people are familiar with, is when you invest your money into this fund, but it's managed by a person, this money manager. And because it's actively managed by a person, their goal is now trying to beat the market, and they're also going to charge you a lot higher fees. And the problem with that is, sure, they're trying to beat the market, but over the long term, most money managers cannot beat the market year after year after year, so you end up actually losing, because you also have to pay much higher fees on top of all of that. Now, there are some instances where a mutual fund can be beneficial if you can get access to the right mutual fund, but in general, that's the thing that you got to be aware of. With ETFs, generally, you have much lower fees because now they're passively managed, meaning that they're managed by a computer. So a computer is going to look at the index, they're going to look at the rules. The rules are here that it's investing in the biggest 500 companies on the stock market. So if a company becomes smaller than one of these top 500 companies, the computer is going to kick that company out and add in a new company. So it's very passive, which is why your fees are less, but you still want to pay attention to what the fees are. The way you do that is by looking at the expense ratio, and here on the Vanguard website, you'll see that the VOO expense ratio is 0.03%, and on the SPDR Spider website, you'll see that the gross expense ratio is 0.0945%. So the expense ratio or fees for VOO and SPY are both extremely low, but the SPY fees or expense ratio is about 3 times higher than VOO, but relatively, they're both very, very, very little. I mean, an expense ratio of 0.03% means that if you invest $1,000, your fees are going to be 30 cents for every $1,000 that you invest, and an expense ratio of 0.09% means that your fees are going to be 90 cents for every $1,000 that you invest. So both very, very little. Now, the reason why I talk about investing in the S&P 500 ETF is because this is a way for you to get general exposure to the stock market. You're just investing in the biggest 500 companies in the stock market, and now if the stock market goes up, your fund will typically go up. If the stock market goes down, your fund will also typically go down. But this is a way for you to grow and compound your money, because now you're just investing your money in the market and letting the market do its thing. So if the economy continues to grow and the market continues to grow, well, now your money's growing and compounding because you have exposure to the general market. You're getting exposure to the American economy and the American stock market. And this is one of the most accessible ways to do that, because you're just investing in the biggest 500 companies on the market. The second type of ETF that you may want to consider investing your money in is a growth ETF, especially if you have more time on your side, because this is a way for you to get exposure into faster growing companies. Now, faster growing typically also means higher risk, but you also have higher potential for more growth. The reason why you want to have some exposure to growth, especially in this economy, is because, well, our economy is not projected to grow as fast over the next decade and couple decades as it has in the previous decades and the previous generations, just because our economy is so much larger now. Back in the day, in our parents' and our grandparents' generation, we saw our economy grow by 5, 6, 7, 8, even 9% a year. But nowadays, we're just trying to see our economy grow by 2% a year. So our economy, because it's so large, and our country, because it's so large, can't grow as fast as it did before. I mean, when you're a smaller company, it's not uncommon to see your company grow by 20 or 40 or even 100% in a year, because you're small and you have the opportunity to gain a lot more market share and you can grow a lot faster. But if you're investing in just the biggest companies, well, you're going to be limited by how fast the economy can grow unless you're really investing in innovation. But if you're already so large, you don't really have the real need to be innovating and creating new products and trying to grow as big as possible, as fast as possible, versus with the growth companies and the growth stocks. These are the companies that are fighting, that are competing, and that are trying to get more market share. So these are the smaller companies that are trying to go faster, but that also means more risk, because now that means that these companies also have a bigger chance of failing and not succeeding. So instead of now you trying to find the right companies to invest in on the growth stage, you can invest in an ETF that will give you exposure to this type of growth. But again, you're going to want to pay attention to these three questions, because what you're going to see is that the ETFs that I'm going to go over here are very different than the ETFs that we just talked about that give you exposure to the S&P 500. Now, some of these ETFs are very different from the others, so let's go over them. VB is the Vanguard Small Cap ETF. So this is an ETF that gives you exposure to small cap, smaller capitalization, smaller companies, and you're trying to get more growth here because you're investing in smaller companies that are trying to go bigger. ARKK is going to be the only actively managed ETF. So this is an ETF that gives you exposure to innovation and is actively managed, not passively managed by a computer. Like the other ETFs that I just talked about is managed by someone named Cathie Wood and her team. She's kind of like a celebrity trader slash investor now. And this is an ETF that gives you exposure to more innovation and innovation type of companies. VUG is another Vanguard ETF. This is an ETF that gives you exposure to growth. This is the Vanguard Growth ETF, and this is investing in companies that are trying to grow bigger, faster. And then you have QQQ. This is the Invesco ETF that gives you exposure to the NASDAQ, and this is giving you exposure to the 100 companies, 100 biggest companies that are not financial. And so what that means technically is for most of these companies, they are tech companies, because the biggest 100 companies on the stock market that are not financial tend to be tech. They don't have to be tech, but most of them tend to be tech because besides financial, the next biggest industry of companies are typically in the tech space. And so QQQ gives you exposure to the biggest 100 companies that are not financial. Now, before we get into the questions, got to give you my disclaimer that I do own some shares of the ARK fund. So when we talk about who made these ETFs, this is Vanguard. This is Vanguard, this was ARK by Cathie Wood, and this is Invesco. All of these are very credible investment companies, and to see how much assets they have, let's look into each of their websites. So starting with VB, the small cap ETF on the Vanguard website, it says that they have $141 billion in assets under management. On the ARKK one, it says they have 21,000 million assets under management, which is 21 billion assets under management. The VUG Vanguard Growth ETF has 183 billion assets under management. And QQQ, I'm going to show you this on the finance.yahoo website because it's easier to find here than on their actual Invesco website. But if you look under the net assets number, it says that they have $192 billion in assets under management. So for all four of these, we know that they're made by all credible companies, and they all have billions of dollars in assets under management, which is significantly higher than the bare minimum of at least $100 million in assets under management. So we're looking good over here, which brings me here. What do they actually invest in? So starting up here with VB. Remember, VB is an ETF that gives you exposure to small cap companies. By definition, a small cap company is a company that's worth less than $2 billion. So now coming back to the Vanguard website, you'll see that their 10 largest holdings are things like the Biotechny Corp or Pool Corp or Diamondback Energy. Unlike the companies in the S&P 500 ETFs, which are worth hundreds of billions, if not trillions of dollars, those were companies that everyone has heard of. There's a good chance that you haven't heard of any of these companies because they're small cap and these companies are trying to grow. You can compare that to something like ARK, ARKK, which is investing in innovation. Here, this has a very different philosophy where Cathie Wood and her team are trying to invest in innovative companies actively, and they're trying to capture the upside that these innovative companies might have in the future, but it also comes with more risk and more volatility. Take a look. ARK's number one holding is Tesla. Then their other top holdings are Coinbase and Roku and Zoom and Shopify. Compared to the other passive ETFs, you'll see a lot more changes in the top holdings for ARK because it's actively managed. And so you'll see them change, which is a top holding. They'll buy and sell stocks a lot more often than these because all the other passively managed ETFs are just letting a computer do its thing. VUG is investing in growth companies, but more specifically, large cap growth companies. So this is investing in companies that have a market cap of over $10 billion. That's the definition of a large cap company. It's worth more than $10 billion. compared to here, this is only investing in small cap companies. VUG's top holdings are companies like Microsoft, Apple, Alphabet, Amazon, Tesla, and Meta, which used to be Facebook. And then you have QQQ investing in the NASDAQ, which are the non-financial companies, and their top holdings are Apple, Microsoft, Amazon, Alphabet, Facebook, and Tesla. This is from Yahoo Finance. So VB is investing in the small cap companies, the smaller companies. This is investing in the large cap growth companies. This is investing in the NASDAQ, the non-financial companies, and this is investing in innovation. Now that we know what these ETFs are investing in, you got to understand the fees. Going back to the websites, VB's expense ratio is 0.05%, so essentially nothing. ARK's expense ratio is 0.75%, which is a lot higher than the others. VUG's expense ratio is 0.04%, and QQQ's expense ratio is 0.2%. So again, for these passively managed ETFs, the fees are pretty negligible because you're not paying for a person to actively manage and buy and sell the stocks, versus here you can see ARK's expense ratio is significantly higher than all the others. The reason being that this is an actively managed fund, and because of that, you're paying a higher expense ratio, and your goal here is to beat the returns of the market. But again, you're going to see a lot more volatility here. Some years you're going to see great returns. Other years you're going to see much lower returns. You might lose money. And so each one of these has its own fair share of risk, and you got to understand what your goal is before you go and invest your money into any of these ETFs. So now we talked about ETFs that give you exposure to the general economy and the general stock market, the S&P 500 ETF. This is an ETF. The growth ETFs are ETFs that give you exposure to growth and more innovation and more upside, because now you're investing in companies that are smaller, trying to acquire more market share. And then I have one more type of ETF that you want to consider buying. That way you can grow and compound your wealth. The third kind of ETF that I want you to consider investing your money in to grow and compound your wealth are emerging market ETFs. These are ETFs that invest in companies overseas and outside of the United States. That way now you can get exposure not just to different companies, but different countries around the world. That way now if the United States economy slows down, or if the United States dollar has issues, or something happens to the United States, you're not out of luck completely, because now you're investing in countries outside of the United States that have their own economies, their own governments, their own systems, and now you're getting exposure to something completely outside of the United States. Now again, this also has its own fair share of risks, because a lot of these countries, especially the emerging markets, might not have as much stability as the United States. But the whole idea here is you're investing in a growing country. So if this country can grow a whole lot bigger, their economy can grow a whole lot bigger, and you're invested in a strong company, well now this company can see a whole lot more upside, because the whole country and the whole economy there is starting to grow. And yeah, the risk is that some of these emerging markets like China rely on the United States to spend a lot of money in that country. But if these countries continue to grow, now you're also getting exposure to different countries and different economies, which is something important for you to consider, because you have a lot of countries and a lot of economies outside the United States that are growing significantly faster than the United States economy, just because the United States economy is so large. It just can't grow as fast as they used to. And so these emerging market ETFs give you exposure to that. Now, before I go into the specific emerging market ETFs, one thing that I do want to mention is that no matter which ETFs that you're investing in, the key for any ETF strategy to work is you have to keep consistently investing your money in ETFs, and you want to do this automatically. This way every week or every month, money is automatically leaving your account and going into these ETFs. And this is something that you want to keep doing whether the market is up or down. The key for this to work is you have to be consistent. You don't want to just put your money in once and just forget about it. You want to keep putting your money in and letting your shares in this ETF grow, because now you're just getting exposure to the different markets, the different stocks, the different companies, and you're just going to keep acquiring shares and let the companies do their thing. And I forgot to mention this just a second ago, but the last key to really make this passive investing strategy work is you have to give it time. The key for this to work is you have to invest your money consistently, passively, and let your money grow and compound, which means you're just going to let your money sit there and continue growing and building on top of it, because your investments need time to appreciate. So a few different emerging market ETFs that you may want to consider looking at are VWO. This is a Vanguard emerging market ETF. EEM, this is an iShares emerging market ETF, and SCHE, this is a Schwab emerging market ETF. Now again, disclaimer, I have my own money invested in VWO and SCHE. So now let's dissect and analyze these three ETFs. The first thing is who made it. We have Vanguard, we have iShares, and we have Schwab. All of them are, again, very reputable and very credible companies that made these ETFs. So let's go a little bit deeper and see the assets under management. Starting with VWO, it says that the fund total net assets are $110 billion. Moving on to SCHE, E, the Schwab ETF, it says that the total net assets are $9 billion. And then the iShares EEM Emerging Market Fund says that the net assets are $28 billion. So again, each one of them passed this test. It's a credible company and they have a large number of assets under management, each one in the multiple billions. The second question, which is even more important here, is what do they invest in? Now, not only are you looking at the companies, but also what kind of company and which countries are these ETFs investing in. See, it's one thing to be investing into a small cap company in the United States. You know that the United States economy is stable, so when you're investing in a small cap company in the United States, it has its own fair share of risk. You're just hoping that this company, which is small, will be able to grow in the stable economy. But now when you look at these emerging markets, now these economies and governments aren't always as stable as the United States, depending on which country that you're investing in. And so a small cap company in an emerging market might have a much harder time growing, or it'll have the possibility to grow significantly larger depending on which country it's in. So this is where you have to be a little bit more picky and know really what your risk tolerance is, because a small cap company in an emerging market is riskier than an investment in a small cap company in the United States, just because of the stability of the economy. This is where you have to know your risk tolerance, and you got to know why you're investing your money. Are you looking to invest your money into emerging markets just to get some diversification in your portfolio, or are you looking at investing in emerging markets that way you can see a whole bunch of potential upside by investing in these growth companies in emerging markets, which could try to take over and become a leading company worldwide starting an emerging market? So let me start by analyzing VWO, the Vanguard Emerging Market Fund. If you scroll down onto the Vanguard page, you'll see the portfolio composition, and you'll see that 99.5% of this ETF is investing in emerging markets, 0.4% is in Europe, and 0.1% is other. And you can look at some of the largest holdings. The number one holding is the Taiwan Semiconductor Manufacturing Company, number two is Tencent, number three is Alibaba, and on and on and on. But you also want to take a look at the countries that it's invested in. So if you come back up and click on the portfolio and management tab, and then you scroll down, you'll see the market allocation of the top countries that it invests in. So the top 5 countries that this ETF invests in are China, followed by Taiwan, followed by India, Brazil, and South Africa. Now I want to remind you that with these type of emerging market ETFs, your risks are different than with just investing your money in a US company. And so now you can see bigger swings in these ETFs and in these companies than you would typically see in a US company. VWO has investments in over 5,000 companies, and you can compare that to EEM, which has investments to about 800 or so companies. And these are companies which are large or mid-cap companies in emerging markets. So if we come down to the holdings section in this ETF, you're going to see that its top holdings are actually similar to the Vanguard fund. The number one in this is the Taiwan Semiconductor Company, then you have Tencent, then you have Samsung, then you have Alibaba. And then if you scroll down a little bit further, you'll see the exposure breakdowns, and then if you click the geography tab, you'll see the top countries that this ETF invests in. So the top countries for this ETF are number one China, then Taiwan, then South Korea, then India, then Brazil. So you can start to see why this question is so important here, because yeah, they do have some similar companies that they invest in, and some similar countries, but they do have different countries, meaning different companies that they also invest in. And this brings us here to the Schwab ETF. So similarly, the Schwab ETF is investing in large and mid-cap companies in emerging markets. It's investing in about 20 or so countries overseas, and we can take a look at some of its top holdings. Under the portfolio tab, you can see the top holdings, which are for here, the Taiwan Semiconductor Company, you have Tencent again, Alibaba again, and then you have companies like Meituan, I think that's how you say it, and Reliance. And then scrolling down to the countries, you'll see that the top countries that this ETF invests in are China, Taiwan, India, Brazil, and South Africa. And now that you know where these ETFs are making their investments, you got to understand the fees. That way you know that you're not overpaying in fees to invest in some countries or companies. So starting with the Vanguard VWO ETF, the expense ratio is 0.1%. Then the iShares EEM ETF, the expense ratio is 0.7%. And then you have the Schwab SCHE ETF, which has an expense ratio of 0.11%. So comparatively, this and this ETF have significantly lower expense ratios than this ETF. So you just got to do your research and see if this expense ratio is worth it for you if you want to invest in emerging markets. So there's 3 different ways of investing, growing, and compounding your money. The first is by investing your money into the S&P 500, which gives you general exposure to the economy and the stock market. Then we have the growth stocks. These are the companies that are fighting to grow bigger, and these are a little bit riskier, but you have a lot more upside with your growth stocks if these growth ETFs ETFs can grow bigger, and the companies within those ETFs can acquire more market share. And then we have the emerging markets. Not only here is it a hedge against the United States, but it's also a way for you to see more potential upside, again, more potential risk here, because you have countries around the world that are trying to grow a lot bigger. They have a lot more potential upside, which means the companies which are innovating and growing within those countries also have the potential for more upside. But the key, again, for any of this to work is you have to keep consistently investing your money. You have to automatically invest your money, and you want to make sure that you let your money invest and grow and compound over time, because this is a long-term play. These are not trading strategies. This is a way for you to build wealth and continually keep investing your money and slowly let your money grow and compound over time. We're going to jump back into the video in just a second, but before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, the Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. If you have $1,000 in your pocket right now and you're trying to figure out how you can flip your $1,000 into $30,000, something a whole lot bigger, and you go into YouTube and Google and you search how to do that, well, chances are you're going to come across one of a few things. You're going to see people talking about flipping cars. You go out and buy a beat up car, that way you can flip it for a profit. Or you can flip NFTs, trying to find an NFT that will be worth a whole lot more, hopefully in the near term future, or trying to flip cryptocurrencies, try to find a cryptocurrency right before it pops and sell it for a quick profit, or you're trying to find a stock that you can buy and sell very quickly, or you're trying to flip currencies on the Forex exchange, Forex. Now, while some of these things might work and they might work for some people, they don't work for me. Like, I don't go out and flip cars. I've never flipped cars before. I don't buy NFTs, and I don't buy cryptocurrency to flip it. I own cryptocurrency as an investment. I don't buy into the Forex markets, and when I buy stocks, I buy them for the long term as an investment. I don't flip them, but I've still been able to flip $1,000 into $30,000 or more without ever buying an NFT, and in this video, I'm gonna be going over some of the ways that I did that. That way you can potentially implement them too. When I went to college, I didn't know what to expect. I grew up in a traditional Indian house, and I thought everybody goes to college to study hard and they spend their Friday evenings in the chemistry lab trying to figure out how they could become even more successful in life, because I thought everybody wanted to go into the medical field because I was supposed to be a doctor. That's what I was told when I was growing up. So I thought that everybody goes to college only to study. Well, when I got to college, I was a little surprised because everybody around me was partying and blowing their money, which they didn't even have. Everybody was drowning in student loans, yet they were still blowing money they didn't have on partying. I didn't know that people partied in college. I was the first person in my family to go to university in the United States, so I didn't know what to expect. I was never really into partying. I don't drink, I never drink, and the whole idea of just spending all night partying just wasn't super attractive to me, but I still needed something to do on Friday nights, so I saw it as an opportunity that maybe I could be the one hosting parties and making money if everybody else is partying. Now, I did get a little bit fortunate here because when I was in high school, I was already working at weddings. So I got to know a lot of the DJs, and we had this idea to host teen parties back when I was in high school. So I knew a little bit about how the party promotion business worked. I knew a little bit about how DJs worked, and I knew quite a few DJs. But this was my opportunity to now really capitalize on this college party business and scene. I was 17 when I got to college. I didn't have a lot of money in my bank account, but I started knocking on doors at every single bar, restaurant, club, and venue on campus, and I asked them a simple question: can I host a party here? And some venues would come back to me and say something like, sure, you can host a party here, but it's gonna cost you $10,000 to reserve the hall. And I was like, oh, well, I don't got $10,000, so that's not gonna work. Then I go to the next place and then they would say, yeah, you can host a party here. It's gonna cost you $30,000. So then I'd go to the next place and then they said, yeah, you can host a party here. We're not gonna charge you anything up front, but all we want is 50% of the cover charge, the money you charge for people to come into the event. So if I charge people $10 to come into the party and 100 people come in, that's $1,000 worth of revenue, and I would give the club 500 and then I would keep the other 500. As soon as I found somebody who'd be willing to give me, this 17-year-old confused brown college kid, access to their club and their hall for free, I knew I was in business. Now all I had to do was figure out how I can get as many people into this club on Friday night as possible, because the more people that come in, the more people that are gonna pay, and the more money that I would make. But I still needed a DJ. Let me just remind you, I'm a 17-year-old kid, so I don't have a lot of money to go out and find a DJ and pay them their full price to come out and DJ my party, so I had to get a little bit creative. So I got to know a few DJs working in the wedding business and started calling them up. And I asked them, how much do you want to DJ? Some of them would say, oh, I want $1,000. Someone would say, I want $750. And then somebody said, you know what? I'll do it for free. Let me be a partner with you in this party. I'll help bring my friends, I'll help promote it, but all I want is a percentage of the money that you make. Now the club is already taking 50% of my gross revenue, and now I'm gonna bring in a DJ who's also gonna take half of the profits that I make, so now 25% of the gross revenue, which only leaves me with 25% of every dollar that we bring in, but at least I don't have to put any money out of my pocket, because now I can start this business without pulling any money out of my pocket because I don't have any money in my pocket. So now I have a venue where I can host my event. I have the music, I have the entertainment. The only thing left is I gotta get people to hear about my party, and I gotta get people to actually wanna come to the party, because if no one comes to the party, well, nobody makes money. I spent $100 hiring a designer to design me a flyer to promote the party, and then I spent another $250 to print 5,000 physical flyers, 4 inches by 6 inches, so almost like a photograph, but there were just these flyers promoting the party, and I got 5,000 of them. And now my goal was to get rid of and distribute all 5,000 flyers before the party starts. The first time I did one of these parties, I was able to flip my $350 investment into $30,000. I'm just kidding. My first party was a complete flop. The studio, the hall, the club that I was doing my party at got shut down the night before. So the night before the party, I had to find a new venue. It was a complete mess. I ended up losing money on the first event, and then we did it again the next month. And the next month, we made a couple $1,000s of profit. That was me. I made a couple $1,000s worth of profit even after paying all of these fees and expenses, because we were able to be creative with our marketing. We were able to get a lot of people to come. We were able to generate a lot of excitement, and I didn't have a lot of costs up front. I would market it with the flyers, and I would do a lot of Facebook marketing and a lot of word of mouth marketing. I would get people excited. We would tell people that we would celebrate their birthdays at our event. We'd give the birthday person free access into the party. That way they would want to come celebrate and bring all of their friends. And so we'd get a lot of different people to kind of word of mouth market the event by themselves. And this is how I started. After doing the same process a handful of times and making a couple $1,000s here, $1,000 there, $1,500 there, I was able to save up a little bit of money. And then I realized, okay, now I got some leverage. I know that I'm able to run these events smoothly. I know the people. I know that I have the contacts. So I went back to the clubs and I would say, I don't want to give you 50% anymore. Let me do it where I get 60% or 75%. So I was able to negotiate a higher rate for myself. And then I went back to the DJs and I said, I don't want to keep giving you half of the money I make. Can we work out a different deal? Or can I just pay you $500 up front? That way now I pay a little bit more money up front, but now I get to make more profit per event. And then I started doing more events. I got in contract with one of the biggest clubs on campus to be their college night promoter. So my face and my party poster was plastered on the side of the building. And every Thursday night, every college night, it was my party. It took me almost a couple of years to make my first $30,000 doing this. But now I was making more money each semester because one, I was able to negotiate better rates for myself, better deals for myself, because now I had some more money to invest back into the business and I'm able to market better. So we're able to bring more people in and we're able to charge more cover because people really want to come to our events. So it was like a punch, a triple punch. And that was when the revenue really started to accelerate, because in the beginning, when I started with just a few $100s, less than $1,000, I was just doing the bare minimum, just trying to get a hall, trying to get somebody to play some music and trying to get people into the event. By the end of my junior year, my third year, now it wasn't just hiring a DJ and having a hall. We had a DJ, the hall, we had hired multiple limos, we had hired school buses, we had VIP service, we had so many different things going on. That way now it's more of a whole production rather than just event. And I still remember this because my biggest event generated more than $16,000 and I couldn't believe it. I did not realize that I could be making this type of money without even finishing college. Now before I go on to the second way that you can flip $1,000 into $30,000, I want to reiterate that it took time, it took a lot of effort, a lot of hard work, and a lot of consistent learning. You have to be willing to do that if you want to flip $1,000 into anything more than $1,000. The second way that you can flip $1,000 into $30,000 is by flipping real estate. And now if you're thinking, how in the world am I gonna buy a real estate property for $1,000? Well, you wanna flip real estate without actually buying the real estate. So when I started making decent money from my event planning business, I wanted to go out and buy myself the BMW 3 Series because I loved BMWs and I loved the 3 Series and I thought it'd be really fitting for me. And I looked at the pricing and I was getting ready to buy it, but then for whatever reason, I decided not to buy the BMW 3 Series. This was at the bottom of the real estate crash. I kept hearing about the real estate market being at rock bottom on the news. I was reading money books and every money book said that wealthy people invested in real estate. So I decided not to go out and buy this BMW 3 Series, and instead I went out and bought my first rental property. I was in college and I bought my first rental property, and that got me really hooked on real estate. So right after that, I went out and I got my real estate salesperson's license. And I got my real estate salesperson's license when I was 19 or 20, and I started working for a brokerage called Keller Williams. And the broker that I was working for happened to be this teacher for some sort of real estate investing. And as soon as I started working there, she got really interested because I was the youngest agent in the office. And so she was wondering what got me into real estate. I told her that I liked real estate investing, and she said, wow, I'm actually a real estate teacher on the investing side. How about you come to one of my seminars? She was charging something like $350 a person to go to one of her seminars, but she gave me a ticket for free because I was an agent in her office. So now I got a free ticket to one of her real estate seminars, and I go there and I learned about this concept of flipping real estate contracts. It's called real estate wholesaling. So I go to the conference and the speakers are talking about how you can go into a contract. Let's say this home right here is worth $150,000. So now what you want to do is you want to find a home like this that's worth $150,000, but you want to find it where there is a motivated seller. Maybe the homeowner here has been trying to sell their home. They don't want to go through an agent, and they've been trying to sell their home, but they haven't been able to do it for whatever reason. And so now you have to find this person, and if you can enter into a contract to buy the home for $135,000, well, now you have the opportunity to make some money. So what you do is you go to the homeowner and you talk to them, you figure out if they want to sell their home, and then you tell them that you want to buy the home for $135,000. And so now you have this contract to buy the home for $135,000. Now at this point you're probably thinking, but if I only have $1,000, how am I gonna buy a $135,000 home? Well, you're only in contract to buy the home for $135,000. Now what you wanna do, because you're a good marketer or you wanna learn how to market this, is you wanna find somebody else, a buyer, who is interested in buying this home, and then you're gonna give this person a little bit of a discount off of the value of the home. Let's say they buy the home for $145,000. So now, what you've done is you entered into a contract to buy this $150,000 home for $135 grand. Now you're gonna turn around and market this contract, you're gonna market this home actually for $145,000. And as you start to build your network of people, it becomes a whole lot easier because you know who wants to buy a home. A lot of times these are investors, because these are people that want to find homes below market value. So if you have an investor that's ready to buy a home and they can get a home below market value, now you're gonna sell them this contract for $145,000. So now what happens? This person pays $145 grand. They go to the homeowner and give them $135,000, and the other $10,000 goes to you for finding the deal and putting together the deal. You just flip the property without having to pay a penny, because now all you did was you got into a contract to buy the home, and then you sold the contract to somebody else. So I learned about this and I got really intrigued. And then they said, if you want to learn more, you can buy the entire program. It was a course that they were selling for $3,500. Now I know $3,500 is more than the $1,000 that we're talking about, but this is actually what happened. Now, $3,500 is a lot of money. And back then it was even more money for me because I didn't have that much money. I mean, I had some success with my party promotion business. I had some success in real estate, but it's still a lot of money. But I decided to go forward with it. I paid them the $3,500. I learned how it worked. And then I started trying to do this. So now I'm on my own and I'm trying to source leads to try to enter into this contract. And I'm going through Craigslist. I'm calling people. I'm driving through roads. I'm driving through streets, driving through neighborhoods, trying to find homes that are available for sale. And I'm trying to get into a contract to buy one of these homes. And month 1, 0 sales. Month 2, 0 sales. Month 3, 0 sales. Month 4, 0 sales. It wasn't until month 5 that I made my first sale, and in month 5 I closed 2 deals. The first deal I closed net me $10,000. The second deal I closed that same month put another $7,500 into my pocket. The cost here that I had to pay for was a $3,500 class that I paid for, but then it was all the time that I put in. I mean, I put in a lot of hours calling people, getting rejected, getting hung up on, and doing that again and again and again and again and again until ultimately month 5, I closed my first deal and my second deal, and then by month 6, I had closed $30,000 worth of total transactions, money coming into my pocket from doing this, and my costs of actually doing the business were very low. I mean, I ended up making a website which wasn't very expensive, maybe cost me a couple $100, and then I put together some marketing material, which again, a few $100s worth of work, but that was it. You don't have to go out and buy a $3,500 class just to start off, but you should be investing in yourself. That means investing in your education, maybe buying classes, maybe watching YouTube videos, maybe reading books. There's a lot of things that you can do to increase your income if you just invest in your own education, whether it's dollars or whether it's time, but you have to learn how you can do this, and that means learning things like negotiating, learning things like the follow-up, learning sales. The education and the things that you learn from doing business can be applied universally for whatever you do. A third thing that I did was I used to flip t-shirts. Now this is a concept that you can apply to pretty much anything where you find a need where people are overpaying for a product, and you can find the exact same product for a cheaper price, and you can sell this to that person who's paying a lot more money at a discounted price. This concept can be applied to anything, but what I used to do was when I was in college, every club, organization, and group on campus would want to get their own custom shirts. They would say things like Squirrel Watching Club, and then they would go to the local t-shirt making company and they would ask them how much would it cost to make the Squirrel Watching Club t-shirts. Well, the t-shirt company on campus would rip them off, and that was opportunity for me. So you wanted to make Squirrel Watching Club t-shirts, and then your organization would go to the big t-shirt making store on campus, and they would say, yeah, we can make you these shirts. It's gonna cost you $7.50. But if you did any sort of research, if you spent any time online, you found out that, hey, I can go online and I can get the exact same shirts made, sorry, my arrows are all screwed up, for $5.50 from an online company. I saw that and I said, Well, this is a lot of opportunity because now what I can do is I can go to every organization on campus and say, hey, you want to get squirrel making shirts? I'm a student here. Let me help you out with that. Instead of you paying $7.50, we will beat them by $1 or at least $1. So now what I do is I found out that I can get it made for $5.50 and I say, you know what? I'll make it for you for $6.50. So you send me the design, you send me the order, I take this order and I go online and I input it and I get it made for $5.50 and I bill you $6.50. So now I'm making $1 per t-shirt. You buy 250 t-shirts, I just made $250 and all I had to do was take your order, take your design and boop, 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 put it onto the internet. When I was in college, this was one of the simplest ways to start generating some extra money because I really didn't have to do much work. I just had to contact the organizations. I went to the directory online and found all the clubs out there and I started emailing every single one. And all I had to do was take the design that you created and input it online and you were the one that was paying for it. I didn't have to put up any upfront money. Now, depending on where you live and what's around you, you might not be able to do the exact same thing with t-shirts, but you have the exact same opportunity with so many other things. Maybe you can find accessories that people are buying from the store and they're paying way too much for it, and you can source these accessories from China. Go to Alibaba.com, go to AliExpress.com, and you can work directly with manufacturers to buy products, and you can sell them directly to people in your area. Elon Musk really demonstrated how this works back in 2021 because he ran a Twitter poll to his followers asking if he should sell his stock. Now, while that seemed like a harmless tweet, he actually had a hidden agenda behind that tweet. Elon Musk doesn't pay any taxes. And the reason why he doesn't pay any taxes is because of what I said in number 1. He doesn't